Good afternoon. I'm Dr. Fasasi Kazim Adiola, popularly known as F.A. Kazim. Today's topic will be on accounting concept and convention. Accounting concept and convention. We'll be looking at accounting concept. What is accounting concept? Accounting concepts are principles principles used to prepare financial statements. Are principles used to prepare financial statements. These principles are very important in accounting. The principles we are talking about helps accountants to prepare accounts in line with accounting standard. If these principles are not used, it may be difficult to prepare accounting that will be accepted by the public and by the general public. Students, you have to know these principles because it will guide you a lot in preparing financial statements. I will list the accounting concepts, and after which we will look at each of these concepts one after the other. Accounting concepts are business entity concept. 2. Historical cost concept. Historical cost concept. 3. Dual concept. 4. Accrual concept. 5. Machine concept. 6. Realization concept. And 7. Going concerned concept. These concepts are very important. We have the business entity concept, the historical cost concept, the dual concept, the accrual concept, the machine concept, realization concept, and going concern concept. We'll be looking at each of these accounting concepts and explain each of them one after the other. The first accounting concept we are going to be looking at and we're going to be explaining is business entity concept. What does this concept state at? Business entity concept stated that business transaction should be separated from business transaction should be separated from the transaction of business owners. What does this mean? Accountants should strictly keep record of business entity and separate them from the owners of the business. Who are the owners of the business? The shareholders. The shareholders' transactions are to be clearly separated from the transactions of the entity, which is the business. For example, let's say AYPLC, the accountant is employed to keep the transactions of only AYPLC and not the transactions of the shareholders of these companies. Reason being that the accountant is employed by the business entity and not by the owners. And the accountant is only responsible to the entity and not to the owners. In that case, accountants should strictly keep record strictly for their companies and not for the owners of the business. In simple word, we can say business entity concept simply means recording transactions for the company only and not for the owners. Thank you. Let's look at the second concept, which is historical cost concept. The second concept is historical cost concept. What do we mean by historical cost concept? This concept stipulates that cost that items should be recorded. Items should be recorded at their original purchase price. This is what historical cost concept is saying. That items are to be recorded at the original cost and their original purchase price, which means if an item is acquired at 100 naira, the item should be recorded at 100 naira and not at the current market price. If another company get the same item at 150 in their company, they are also to record their own at 150 naira. What we mean is this: items are to be recorded in the financial statement at the original purchase price, which means at the price it was recorded on the source document in order to avoid fraud or suspicious recording. And what this historical concept is all about is that if an item is acquired 20 years ago at 500,000 naira and those items are still existing in the company's financial record, these items are still to be showing at 500,000 naira, which is their original purchase price. Even if those items presently worth 2 million naira, accountant cannot record at the present market price of the item, rather at the price the item was acquired 10 years ago. Thank you. The next accounting concept we will be looking at is dual concept. Dual concept. What is dual concept? Dual concept stated that transactions are to be recorded. Transactions are to be recorded twice as debit and credit entry. What this is really talking about is that all transactions in accounting must be recorded twice. Accountants should not keep transactions more than recording it twice, the debit and the credit. To beginners, what does debit? Debit means to receive. And what does credit mean? Credit means to give, which means in business, you keep record of item you are receiving and item that you are giving out. This process is called double entry, and it is backed up by the principle called dual concept. Accountants are to keep minimum of 2 accounts from each transactions, and this is in line with the guidelines of dual concept. Let's look at the next concept. The next concept is talking about accrual concept. It's talking about Accrual Concept. What is Accrual Concept? Accrual Concept stated that expenses incurred, but yet to be paid for, yet to be paid for should be recognized, should be recognized in the financial statement. In the financial statement. What do you mean by this? Accrual in the literal language means owing. And what do you mean by owing? It means if an expenses is incurred, but payment has not been made. This concept allows us to record such transactions. Transactions for transactions that are on credit are to be recorded. And this is in line with Accrual Concept. What it means is if you bought goods on credit and payment has not been made, you have to keep the record in the financial statement. If you rent a factory for your business and payment has not been made for such factory, is to be recorded in the financial statement, which means accounting record for items that are on credit are recognized by Accrual Concept. The next accounting concept we'll be looking at is realization concept. Realization concept. Realization concept stated that revenue can only be realized when goods are delivered. When goods are delivered to the customer, when goods are delivered to the customer, that is when revenue can be realized. What this means is that you don't earn revenue when goods has not been delivered to your customer. And we have learned one or two things here, that organization can only realize their revenue or earn their revenue only on the condition that goods has been delivered to the customer and customer has accepted the goods. This is the reason why some organization in Nigeria, when sending goods to you, it will be stated on the receipt that if you are not okay with these goods, you can return it within 7 days. If after 7 days, these goods are not returned, it will be assumed that the customer has accepted the goods. And this will pave way to the organization to earn their revenue and realize their revenue. And what have we learned here? That if goods has not been delivered, you have not earned a revenue. If goods has not been delivered to customer and customer has accepted that goods, revenue is not yet to be realized, not until when goods are delivered. Revenue can only be realized or earned when goods are delivered to their customer. That is what the realization concept is all about. The next concept we'll be looking at is margin concept. Margin concept. What is margin concept? Margin concept stipulates that revenue relating to accounting period and expenses relating to the same accounting period, to the same accounting period, to the same accounting period should be merged together, should be merged together. What does this mean? Expenses relating to an accounting period and revenue also relating to the same accounting period can be used to determine profit or loss for the same accounting period. In a nutshell, what this means is that you can deduct sales of 2025 of 2024 from the expenses of 2025. The expenses that will be deducted from the sales of 2024 must be the expenses incurred in 2024. Expenses and revenue within the same accounting period can be merged to determine profit. But expenses of another year cannot be used to determine the profit from revenue of another year, which means that this is a very good guidelines for accountants, that if goods are sold, in some cases, customer pay upfront for like 15 months. An accounting period is 12 months. What the accountant is to do is to apportion the sales of 12 months out of the 15 months and push the remaining 3 months to another accounting period. The reason is this: the sales of that 12 months that is apportioned will be used to deduct from the expenses of the same 12 months in order to arrive at profit for the same period. And these are teachers that accountants are not to deduct revenue of a previous year from expenses of a current year, or revenue of a current year from expenses of another year. I think what this concept is saying is that you can only merge revenue and expenses of the same year in the same accounting period. Let's look at the next accounting concept. The next accounting concept is going concern concept, which is the last accounting concept we are going to be looking at. That's going concern concept. What does this mean? Going concern concept assume that transactions are to be recorded as if the business will exist for unforeseen what period. What this concept is saying is an assumption that transaction of an organization should be recorded as if the company will exist for life. That accountants should assume that the organization in which their transaction is being recorded is going to exist for life. You don't assume that the business you are keeping its transaction will collapse tomorrow morning. No. You record as if the business will still exist in the next 100 years. But we all know that business may not exist for life. That is why the concept is based on assumption. Assumption is that businesses will exist for life. We all know that even some businesses that were established yesterday has folded up today. Some businesses only exist for 4 days. Even some businesses, they only exist with only company name. And after company name, you will not see the company even doing anything after the company name. Meaning it's an assumption that accountants should always see the entity they are working for as an entity that will exist for unforeseen period. This is accounting concept. We have looked at business entity concept. We stated that the transaction of the business should be separated from the transaction of the owners.